everyone. Welcome back. Good to see you guys. Today, I want to go straight into the 5 limiting beliefs or false narratives about passive investing. Number 1 is a lot of people think passive investing is too simple to work. People think that if there's not a ton of effort and a ton of time that goes into something, then, this must not work. It really is as easy as saving money and consistently putting it into something that's going to grow over time, whether those are index funds, stocks, real estate, bonds, whatever it is. Consistent effort is the key, and it really is simple. So don't let the simplicity turn you away from it. Number 2 is needing to pick individual stocks to be successful. A lot of people just sit on the sidelines and their lazy money never goes to work for them. They think that they have to devote a ton of time and research into picking individual companies or spending a ton of time vetting real estate deals and getting very active in it. There are so many ways to limit the amount of time that you spend picking individual things or investing in individual things. What I really like to do when I diversify, I know and understand real estate. And so that's what I really like to invest in because I can control a lot of these assets. I know the market really well. I've kind of got an edge locally on things when we rezone and add value to the property. So I understand that really. So I'm heavily allocated. But when I do diversify, I want to diversify into things that have as little risk as possible and are basically diversified into a bunch of things. Like when I buy stocks, I buy the VTSAX with Vanguard. It has super low fees, and it basically tracks the performance of the S&P 500, which most people can't even beat that. So if I can match it, I feel like I'm doing really, really well. It didn't take me a whole lot of time to figure that out. I'm very careful to avoid, fees from financial advisors and mutual funds. I typically don't like that. If you don't know the effect that fees have on your portfolio long-term, I encourage you to go to Google and look at it. We're talking about millions of dollars, even a 1% fee that the broker pays, that the financial advisor, you pay them no matter what your portfolio does. If it goes up or down, they still get that 1% fee. And then usually what they're investing you in also has fees. A lot of people don't know that. Look at the effect that has over a 20-30 year period. It is amazing. But you don't have to go and pick out, individual stocks or individual little real estate deals and spend a ton of time. There are plenty of investments with a couple clicks, you can literally invest in it. A third limiting belief is passive investing is too boring. People think that this needs to be some kind of like fun and exciting thing that, keeps you on the edge of your seat. A lot of times, if you're on the edge of your seat, that usually means you're making emotional decisions, and emotional decisions are not good investing decisions. But a lot of people think that because it's boring that they shouldn't do it. They're associating excitement with investing, and oh my gosh, if this isn't exciting, then I don't want to do it. And that's a big mistake a lot of people make, is they make investing decisions based on their emotions instead of rationality. Usually rationality is very boring. Emotion is usually very exciting. And we've got it completely flip-flopped on how we should invest. But it does not have to be super exciting for it to work. It is okay that passive investing is very boring. That honestly means that it's passive. It means you are getting income to your bank account doing little to no work. Your money is doing the work for you. Another big false narrative that I hear a lot is people sit on the sidelines and wait for a correction. Or they say, man, I'm gonna wait for it to go back down. Or, it's really hot. It's gone up a lot. I'm gonna wait. Or, dude, it's on its way down. I'm gonna wait for it to recover for a little bit. They sit on the sidelines. One of my friends back in 2016 or 17 was waiting to jump into the stock market because it had this historic run, from like 2009, 10, all the way up to 2016, 17. It had a pretty good run. The returns were there. And he's like, it's just too much. He's literally missed out on all of those gains that have happened since then. So do not try to time the market and invest based on what you know, what you understand, and the fundamentals, and avoid making emotional decisions. Next, another big limiting belief and false narrative that I hear a lot of is some investors believe that passive investing is like a one-size-fits-all pill. That, this is something that is general, it's universal, it's not going to fit my own custom needs. it couldn't be more further from the truth. There are so many different ways to customize passive income into a variety of assets. Typically, uh, if you're a financial advisor, what you see a lot of these financial advisors advise, especially young folks, is to be aggressive, a little bit higher or more high risk, assets like stocks that are growth, very high growth funds, because they're going to be investing for the long run. Whereas if you're a lot older, typically over time from young, when you go from, young to old, you amortize down your portfolio into more safe, lower return, but lower risk assets that don't fluctuate as much, usually treasury bills and bonds. And so, both of these can provide passive income either through a dividend, through a stock that you invest in when you're younger, or if it's a bond that pays out like an annuity does. Annuities are another asset class that older demographics can invest in and get consistent income that's usually lower risk compared to the stock market and other things out there. There's so many different ways to do it. Real estate, rental properties, investing in REITs. There's so many different ways to do it. There's not a one size fits all pill. You can customize passive income based on your own individual needs. And lastly, the biggest, and this one drives me nuts the most because I've seen this happen time and time again, is people think to passively invest, they need to go after these home run deals, these for surefire things. I have recently seen this happen multiple times over and over again. My dad, I'm gonna throw him under the bus here because Dad, you made a really crappy decision, not once but twice, on investing. Luckily, it wasn't a lot of money. This was just some play money. So just kidding, Dad. Not trying to throw you under the bus. But I saw him invest in this Ponzi scheme online. Guys he'd never talked to. And it was this Ponzi scheme where you would invest in this crypto trading algorithm. And what it did was you bought Bitcoin, and the algorithm would go out and look for little bitty pricing discrepancies. In other words, it would try to go out and buy and sell like little bitty 1 and 2 cent trades very, very quickly. And, it would do this, hundreds of times a day sometimes, and it would collect pennies. And it was working mainly because there were more people pushing money into it to feed the returns that everyone was getting. And he was getting these crazy, like 30% returns in like a month. I mean, it was insane. And he had buddies that were putting in 100 here, 200 here. It was crazy. Well, they ended up getting an email saying that, hey, something has gone wrong and we're not sure what happened. This operation's been shut down and we can't get you your capital back. And basically they just walked away with this money. The other one was this guy who was saying that he could get these crazy returns in Forex. He had turned like $8,500 into $135,000 and had just all these people excited. And it was friends and family and network. And, my dad put in some money, and this was like a family friend. I knew this guy. And long story short, this guy ended up losing everybody's money. So don't be attracted to just crazy returns. In fact, if it sounds too good to be true, it typically is, that's usually a red flag. So if you hear somebody giving away some crazy returns, be super, super skeptical of that. All right. That's it for today. We'll catch you next time.